Ladies and gentlemen, we will now begin a World Economic View from Michigan, hosted by GalaxE.Solutions. Please welcome the founder, chairman, and chief executive officer of GalaxE.Solutions, Tim Bryan.
Thank you. Just want to welcome everyone to this presentation. We're thrilled to be here as a company that came to Michigan from New Jersey, an international company. We are very much pleased to have been adopted by the state of Michigan and the city of Detroit. One of our missions here that we've made such a significant investment in Detroit is to encourage others to do the same. And as you all have seen, there's been fantastic media presentations trying to attract businesses to the city of Detroit and the state of Michigan. We also felt it was important to highlight the side of Detroit that people don't necessarily think about, which is all the fun stuff that's going on there. The fact that you can go through Detroit at any point in time and be in a fantastic park or see ball games or any of the other wonderful activities. So in that vein, at GalaxE, we came up with the campaign of a love letter from the city of Detroit to the world, reminding it how fantastic Detroit is. So this premiered yesterday in the big room, and I hope you'll indulge us to take another look at our Love Detroit video.
Hey, how's it going? Things here have been amazing. Seriously, Detroit is getting more exciting every day. If you've been waiting for the right moment to visit, I think it's time. There are so many things I want to show you here. So many places to explore. Within a few blocks, we can get cultured or get crazy. Want to catch a game? See a show? On the same block, we can cheer on the home team till the fat lady sings. You're gonna love Detroit. If you're feeling mellow, we can take a walk in the park or kick back and enjoy our own island paradise. Yes, in downtown Detroit. Want to work up a sweat? Maybe cruise through town. In Detroit, you can check out the latest and greatest, or see firsthand where it all began. And if you're feeling really adventurous, we can chase the devil out of town at top speed, from Midtown to Greektown, and everywhere in between. You're going to love Detroit. I just know it. You have to come visit. Love Detroit.
Thank you. The purpose of that campaign, in addition to promoting the city, is obviously to put us on the footing that we need to be to attract human resources, people to the city, to live and work there. And that's part of an overall challenge that we're going to face as an international competitor. Because in our business, which is information technology, software development, the firms that have the great people, the great resources, are the firms that are going to win. And there is an international competition going on now at an unbelievable rate to try to attract the best people into companies. And Detroit, fortunately, is on the forefront of companies looking to locate there in order to attract people and do business in Detroit. You see it in our burgeoning IT hub with all the major players that you well know, like Quicken, CompuWare, et cetera, that are in the IT space. So our challenge here is to compete economically internationally, which brings us to our guest speaker. Ron Insana has been in the economic journalism space for almost 30 years. The people he's interviewed and interacted with are virtual who's who of political and economic importance. He came and spoke with us last year. You may remember the controversy he generated by pointing out that Greece should not be thought of as a country anymore, just a tourist destination. Notwithstanding the fact that he's not welcome in diners in New Jersey anymore, he is welcome here. So please join me in greeting Ron Insana.
Yes, most diners, in fact, in New Jersey are run by Greeks, so I go to delis now, and I'm much safer there. Thank you for having me back. This is really one of the unique spots that I've been to in the course of my travels. I do about 45 events a year, and so it pretty much takes me around the country, and I spend a lot of time in a variety of different places. And the best part about it is the whole experience is that it gives me a real flavor for what's happening on the ground in the U.S. economy. And I think as I've gone through this experience over the last several years, it's really altered my view, having been and I appropriately pessimistic in 2007 and 2008 as we were going into the crisis. Coming out in 2009 and over the last 4 years, I've become increasingly upbeat about the prospects for the American economy, not only in relative terms when compared to the rest of the world, including countries like Greece, to which we are sometimes compared by some of our politicians, but also in absolute terms where a lot of good things, to use a Detroit metaphor, that underneath the hood that are going on are actually quite positive. I should make one point. Tim made it very clear to me that I was not his first choice to come back and speak to you today. He had invited Jim Cramer, but today's Jim's medication holiday, so he can't be here. And as I was leaving, I was checking the market, by the way, the Federal Reserve, Ben Bernanke had just spoken a few minutes ago, and he talked further about cutting off the stimulus program that is currently underway as the economy strengthens. The Dow is down about 300 points when I left my room, so we took a little hit this morning. That's actually not true. I'm just seeing if you're paying attention. Market was up about 80 when I left my room. Everything's fine. But good. And for those of you with pacemakers, I apologize. So that's just maybe to give a little background, I don't know how many of you were in the library last year, just by show of hands. I'll give you a little, well, most of you. So my background extends, as of next week, to 30 years in the financial news business, 29 years, pardon me. I came out of Cal State Northridge, which is in Southern California, as a film major with every expectation that I would be writing and producing comedies on television or dramas in the motion picture arena. And the only job I could get coming out of school was at Financial News Network, where a friend of mine from high school was working. And this is June of 1984, very early days of cable. FNN was in roughly 11 or 12 million homes when I got there, half of which, for those of you who are old enough to remember this expression, were connected to UHF stations. So very low power, small signal type things, and the rest was cable before cable was cool. And so along with CNN and ESPN, we were a handful of the early stations that were out, but we were certainly not widely distributed. And so I went there as that was the only job I could get coming out of college, and I started an entry-level position. 4 months after I got there, I was fired. FNN went through a massive cutback in October of 1984. I was the last person in. I was the first to be let go, and a week after I left, 90% of the editorial staff was fired, leaving my friend Casey Wyan, who had gotten me the job, and Bill Griffith and Sue Herrera, who you should still know from CNBC today. They were our principal anchors, and their job for the next many months was to do 8 hours of live television programming a day, ad-libbing business news for that entire period between them with a couple of contributors. And my friend Casey was producing some of that programming. I went back to the vitamin store where I worked in college and started looking for work again. Couldn't find any. 4 months after I left, Casey called me up and asked me if I wanted his job as a producer at Financial News Network after having effectively just ripped wires and handed out scripts and did things like that my first go-round. So I took the job. 3 months after that, Bill and Sue had been on the air for a good 6 or 7 months on their own, literally splitting 8 hours of live television between them every day on an ad lib basis. In May of 1985, they both called in sick on the same day. And an enterprising young producer gave me the opportunity to go on air that day. The fact that I was that producer is probably immaterial for the purposes of this conversation, but I was the only person in the room. And so I got on for a couple of updates, and through a little manipulation and through a lot of help from Bill Griffith, who was the boss at the time, I managed to stay on for another 21 years full-time before I, in 2006, went off to start a fund of hedge funds business. I worked for a large hedge fund that's been in the news lately, SAC Capital. And then over the last several years, I've been combining speaking, CNBC, and a few other things to make a living. And it's been a fascinating experience. That whole experience leading up, in fact, to my first time on the air, where I had no on-air experience, did not understand economics, had no idea what I was talking about when I went on. You can see much of television hasn't changed since those days. It's still pretty much the same in the news business. But it was a remarkable journey, one in which I was able to effectively get a master's in economics and get paid at the same time. We were free at that point to effectively do anything we wanted. Our management team didn't watch the show. So basically, we would spend the entire day covering what we thought was important and then doing deep dives on these various topics that were moving markets. And so you got into it as deeply as you wanted to with very little interference. And over the course of several years, started to more fully understand, with the help of some very good mentors, what I was covering on a daily basis. And rather serendipitously, again, just a couple years later, I was off visiting a friend of mine in Chicago who I'd known since elementary school, and he was going to Northwestern to get his medical degree. And so I went out for a week just to hang out and get a flavor of that city. I hadn't really spent, I think, more than a few hours passing through. And so he invited me out so we could hang out together. And I went out, and I got to Chicago with a green light from Bill Griffith, who said that I could do a couple things. Number one was do a live report on Financial News Network. That Monday morning, we did a show with the Chicago Board Options Exchange every Monday morning at 10:30 Eastern Time. So he was going to let me do a live report from the CBOE, and I was going to take an options trading class while my friend was in school so that I could better understand some of the things that I was covering. So I get to the CBOE that Monday morning, October 19th, 1987. It turns out to be the single biggest crash in stock market history, and that was my first live reporting experience in the 2.5 years that I've been on the air. And so, again, trial by fire. I was thrown into something that was far bigger than I could possibly understand at the time. But also, at that juncture, it was a seminal event, not only for me as a reporter and a journalist, but for economic policy in the United States. If you go back to that day, Alan Greenspan cut interest rates dramatically, flooded the system with money, backstopped the banks, the brokers, the specialists, and he had only been on the job for 2 months. Alan Greenspan took the job as Federal Reserve Chairman in August of 1987, just as the Dow hit its all-time high. The all-time high in August of 1987, by the way, was 2722 on the Dow Jones Industrial Average. And the market had gone up 1,000 points in the last year, and then subsequently crashed, going down 23% in a single day on October 19th. So not only did I have that reporting experience, but that was a seminal moment in policy responses to economic crises, or financial market crises, I should say, in the US. And from that point forward, it was the template for other interventions that we saw in the early 1990s, the mid-90s, the Asian crisis in 97, Russia and long-term capital in 98, the internet bubble bursting in 2000, and subsequently the events of 9/11. And then again, most recently, when we had this enormous credit crisis, the Fed responded this time with even more force and in a much more aggressive way than it ever had before, and effectively turned the economy around and kept us from going into a depression. For those of you who live in this state, you probably have a more profound understanding of how close we came to going over the edge of the cliff than I think even some of us who live in New York and were working in the financial industry. Now, those of us who were very close to the center of the universe at that time, I think had a very deep understanding of how close we were to seeing the banks go out and possibly be nationalized by the federal government. You know very well what government intervention looks like in the automobile industry. All those efforts, along with the Federal Reserve's unprecedented actions to drive interest rates down to zero, to start this process we call quantitative easing or bond buying, to hold down interest rates and rejuvenate the economy, was extraordinarily successful, even though the Fed still has its critics today. And it's remarkable to me, actually, that Ben Bernanke, who should be hailed as a hero, an individual who literally, almost on his own, kept us from going into another Great Depression, pulled us back from the precipice. If you go back, to the depths of that crisis, when I was working at SAC Capital, which is a large hedge fund that is making headlines for all the wrong reasons these days. But I started there the week before Lehman Brothers blew up. And we saw things happening in the marketplace that were, virtually unprecedented. Hundreds of billions of dollars a day going out of money market mutual funds. The rumors were quite active about Citibank or Citigroup or Bank of America being taken over by the federal government. People were pulling cash, guys that I worked with. In fact, one individual with whom I worked at SAC, who was probably worth several $100 million, took out 3 years of living expenses in cash, put it in a safe, and bought a gun. That's where everybody's head was in the winter of 2008. That's how close we were to going over the edge. Mervyn King, who was the outgoing head of the Bank of England, had said at the time, we were within 3 hours of a systemic global financial meltdown that was going to just swing entirely around the globe. And the Fed intervened rather dramatically, and again, interest rates went to zero, and things started to turn, and the world started to change. And lo and behold, some 4.5 years later, we're sitting with the Dow Jones Industrial Average at nearly 15,400. It bottomed at 6,500 in March of 2009. The S&P's gone up 145% since then. GDP is higher today than it was in 2007. So are retail sales. As you well know, automobile sales dropped to 9 million units in 2009. We're above 15 million units today. That is a remarkable turnaround in an environment when no one expected that to happen, certainly not by now, and probably not for the next 10 years. Real estate has turned pretty dramatically. In fact, after having a glut of homes around the country in 2008, 9, and 10, we now have a shortage of homes. And if you look at all the statistics that are out today, there's a 5.2-month supply of housing, both new and existing single-family homes. It's the biggest shortage we've seen in about 13 years, which is why prices are shooting higher all of a sudden. They're up 11% year over year, and people are unable to get a hold of a house. One, because prices are moving so quickly, and two, there's some constraints in the banking system, which, by the way, I talked to one of your senators about this morning, Debbie Stabenow, mentioned that they might want to look into the regulatory environment a little bit because regulators are choking off available credit. Credit is very cheap. It's not very available, and some of that is not, as a consequence, we're not transmitting the Fed's easy money policies to the people who need it most. That's one fly in the ointment. But by and large, having looked at this over the last 4 years, having traveled around the country for the last 4 years, and having really taken stock of what's going on inside the economy, my speaking topics have changed. In 2000, well, if you'd seen me in 2007 or 2008, I had always recommended the waitstaff take sharp objects off the tables before I spoke. Because what we saw from an investor perspective was far different, I think, than what anybody else saw, even my colleagues who were journalists, having gone into the money management business and having credit exposure during that crisis. It looked horrible in the summer of 2007, only to get much, much worse by the winter of 2008. But by 2009, when all these interventions started taking place, and they were massive, and they've been paid back. That's something else that no one is entirely willing to recognize yet. They worked quite well. And so I focused on the turn. The first turn was the macro turn. The Fed's intervention meant you have to buy stocks, and quite frankly, you should buy real estate. With interest rates at zero, there's nowhere else to put your money. So in March of 2009, you could have picked up a variety of stocks. Citibank at 97 cents. You could have picked up Ford at $1, which is now at 15. You could have picked up Bank of America at 3 or 4. It's gone back up to 15. It's been as high as 20. There were all kinds of ways to make money, and that was a macro trade that really lasted a couple years and continues today as long as the Fed stays easy. And then as things progressed, some unexpected developments occurred, not the least of which, again, as I've changed the course of my speaking from that macro recommendation to talking about there's no place like home. Once the Fed intervened, we were far more stable than Europe or other parts of the world. When our GDP dropped 8% at the depths of the recession, Chinese exports fell 35% at the same time. So it gave you an automatic indicator of the U.S., in as much trouble as we were, still faring better than every place else that sells into the United States. And so that was the kind of the second phase, that there's no place like home. We were going to fare better in this process than most other countries who are probably more dependent on us than we are on them. And as I started looking at some other factors, I was reading a great piece by Ambrose Evans Pritchard, who you may not know. He's a great writer in the Financial Times, does a lot of thought pieces. He started talking about the phoenix rising from the ashes, and started mentioning the conventional energy revolution that we're going through here. We've noticed also, as a consequence, manufacturing, as you point out in the video, is coming back to the United States. And so I started thinking more about this and started thinking about the dawn of the American decade, which led me this year to talk more forcefully about Fortress America. When you look at the entire world, the world is considerably weaker than the United States, almost everywhere. Europe is still in recession. China is slowing materially. India cannot get its political or economic act together. Brazil has slowed noticeably. Russia, you simply can't invest in for a variety of reasons. Even though the market's going up, it's a dangerous place to put your money. The United States, meanwhile, has got a roaring bull market in stocks. You've got this conventional energy revolution, which may be the single largest economic development of our adult lifetime. In the last 12 months alone, the increase in oil production is larger in a 12-month period than any other year in the history of oil production in the United States, which goes back to the 1850s. A single-year increase was the largest ever. In 2020, we'll be a larger oil producer than Saudi Arabia or Russia. We're already about to become a larger natural gas producer than Russia, which is the largest in the world. We've added over 600,000 jobs in the energy sector in the last several years. The average starting pay for a college engineer who goes to work in the oil fields in North Dakota or in Texas or in Western Pennsylvania is $77,000 a year. The average salary for someone working at a McDonald's in one of those locations is about $17 an hour. There is a lot happening, and it's not just that those localities are booming. There's a $1 trillion shale opportunity in California. There are opportunities in upstate New York, Western Pennsylvania, Texas, North Dakota, Southern Ohio, any area that has shale deposits where they can be safely exploited without necessarily, and one of the issues we have in New York is all our water in downstate New York comes from upstate New York where the shale deposits are. So I can promise you that New York City residents, as bad as the water is now, are very unlikely to approve shale projects upstate because the water comes directly to us. Having said that, this is an enormous game changer. Not only are we going to be a large producer and become energy independent within the next 5 to 7 years, we're also going to become a net exporter of energy products for the first time since the 1960s and 70s, which will change the current account deficit, merchandise trade deficit, and the way in which we finance declining budget deficits. This year's budget deficit is going to be $645 billion, down from a peak of $1.4 trillion, and it was revised down by $200 billion this year alone. So our finances are even changing. So when people, as we discussed last year, were comparing us rather inaccurately to Greece, our deficit is on a downward path. And again, that's in absolute terms, and relative to the rest of the world, we are not accelerating our debt to GDP ratio nearly as fast as in Italy, Japan, or the peripheral countries of Europe. So that is going for us as well. Manufacturing is coming home for a variety of reasons. The cost differential between the US and China has narrowed significantly for 3 different reasons: currency differential, wage differential, and the cost of shipping overland and overseas has gone up so much in China, but come down so much here that we hear that manufacturers are coming back in a variety of different industries. Technology, where iteration is now getting closer to production, and there's some talk in the technology community about how important it is, and this is a rather belated revelation, to have the people coming up with the ideas working more closely, both in time terms as well as distance terms, to getting a product to market. So even technology is coming home. Basic manufacturing coming home, advanced manufacturing coming home. All of those things are important. German companies are looking at the United States to domicile manufacturing facilities because natural gas in the US is 1/5 the cost of how much it is in Europe. That's a huge differential. And so, again, there's an enormous move to come here. It hasn't been universally felt in the United States, but it's happening. It's not happening, I think, as fast enough as some people would like, but it's happening, and it's going to be having a profound influence on the US economy. When you take our political situation, as horrible as it seems to us who have gone through this situation over the last several years in which we've had the debt ceiling crisis and a variety of different things take place at the end of last year, the fiscal cliff, the sequestration, all of these things have come and gone with barely a ripple effect on the economy. We've even actually, unfortunately, absorbed higher tax rates, and it hasn't really blunted growth. If you take fiscal drag out of the first quarter GDP numbers, we would have grown at 4%. Not 2.4%, which was the revised number released this morning. So the private sector is actually doing quite well, and then has these other elements going for it also. And you add technological innovation to that, and it becomes an increasingly virtuous circle that has a very long tail. And you can't say that about too many other developed or developing nations in the rest of the world. China, in my estimation, is more likely to have a hard landing than a soft landing. First, they fudge their numbers, so we don't really know how fast they're growing anyway. Second, it's almost impossible to move another couple 100 million people from the farmlands into the cities. There are ghost towns in China that are the size of Shanghai that are virtually unoccupied. There are 65 million homes in China that go unoccupied. They're having a very tough internal transition, and they're having an even harder time changing from an export-oriented country to a consumption-oriented country. They're still exactly the opposite of the United States in terms of economic composition. We're 70% consumption with 30% everything else. They're 35% consumption, 65% exports. So as long as they're in that situation, we count more to them than they do to us. And we're seeing that increasingly all over the world. And we also have a demographic advantage that other countries don't have. Our population replacement rate is about 1.91 children per woman, which is how you measure the population replacement rates in these countries. And the CIA has a whole page of economic stats. You can find out what all the population replacement rates are around the world. So you need roughly 2 kids per woman in order to repopulate the country sufficiently. We added, I think, an extra 9/10 of a kid in my family, so we're doing pretty well. We're doing our job. But in China, it's under 1.5. In Japan, it's 1.3. Japan's going to lose 30 million people in the next 20 years in terms of absolute population size. And if you look at the demographics of Europe, they're equally dismal, whether it's Germany, France, or even the peripheral countries where they're aging faster than they are replacing their populations. So even there, we have an advantage. And once they finish immigration reform, it's expected we could see an influx of about 33 million people. And once they relax the visas for advanced and highly skilled workers, that will help to narrow the gap and fill those empty jobs that unfortunately aren't going to Americans right now because we have a skills gap, but would also, as highly skilled immigrants come in, raise productivity and raise output, and again, make the U.S. much more competitive than it currently is. So from that perspective, I've been thinking about this notion of Fortress America, how we are becoming increasingly less vulnerable to external shocks. In a couple of years, it won't matter if Iran goes offline with respect to oil production. In a couple of years, it may not matter so much that China falls off a cliff because we're producing here at home and meeting our own consumption demand quite well. And that will be most true in energy. And that will change the geopolitical mix as well. We could potentially spend less on defense if we no longer have to intervene in the Middle East, save for protecting Israel, which is the lone democracy in the region. We won't necessarily have to get so involved in these far-flung operations that cost, in the last 2 efforts, a couple $1 trillion. And so the implications are very wide-ranging and all beneficial. I mean, there certainly are some potential negatives, that a policy mistake occurs, Federal Reserve raises rates preemptively before the economy is really on a self-sustaining path. There could be other policy mistakes in Washington that arise out of any number of different disputes between the parties. But generally speaking, the composition of the economy has changed so dramatically that I think in the next 10 years, and this is, I think, a benefit to a state like Michigan, it will look much more like the 1950s and the 1960s than the 80s, 90s, and the last decade. Because the distribution of jobs will be much more oriented towards manufacturing, towards innovation, towards production, physical production of some kind, as opposed to the knowledge-based stuff that we did in finance over the last 20 years, where finance came to dominate the U.S. economy. I think Wall Street may have less of an impact going forward, and the types of jobs that support Main Street will have a larger impact in the years ahead. And that will help to redress some of the income imbalances that we've seen over the last 20 or 30 years as well. So I'm greatly optimistic. And unfortunately, I go to battle on CNBC, and I'm on a couple times a week with a whole host of individuals who have been predicting for the last 4 years that we're going into another depression, that we're going to have another stock market crash, we're going to have hyperinflation, or we're going to have deflation. Whether it's Nouriel Roubini, Peter Schiff, a whole host of these individuals, Harry Dent, who is now predicting Dow 3000 by the year 2019. So for those of you who want to get aggressively short right now, and hope that he's right, there's just been no end to the voices who keep saying we're done. And it's one of the reasons I remain so steadfastly bullish is this is the most hated bull market in my adult lifetime. We're up 145% and nobody's invested, which means the last marginal dollar hasn't come in. When you talk about the economy, everybody keeps saying we're in recession. Now, we are underemployed by every measure, and there's no doubt that's true. But part of that is structural. We have thousands of people retiring every single day who are leaving the workforce for that reason. We have a skills gap between those people who, let's say, were laid off in construction who can't go easily get a manufacturing job where you need knowledge in software programming, robotics, and things like that. So that transfer isn't that easy to undertake. Some people are pinned to their homes because they're underwater on their mortgages, so their mobility is not quite as great as it once was. So we have some structural and in the case of mobility, cyclical issues that are restraining employment from coming back as quickly as it has in other recessions. Now, having said that, given the shock that we experienced in 2008 and 2009, to me, I still think it's remarkable that we are where we are today, and that the prognosis, I think, is considerably better than most people would realize. People get hung up on fighting or arguing the last battle, that somehow we're in store for another crash. When you go back and think that in 2000 we crashed, the Dow went down 50%, the NASDAQ went down 70%, the average internet stock went down 90% if it didn't disappear altogether. In this most recent crisis, the Dow went down 50%, the average bank went down 90%, so we had a depression-like experience in the banking sector, and unemployment rose to levels we haven't seen since the 1981-82 recession, the double dip that we saw back then. And instead of having an inflation, we had a deflationary experience, which the Fed is currently fighting quite adequately. So I think, you know, despite all those things, despite the concerns, despite this constant drumbeat of negativity, Armageddon, in fact, has become a cottage industry in the United States. You know, people are making a lot of money on books, on newsletters, on horrible prognostications. If you listen to any one of these people in the last 40 years, you would have lost your shirt. It wasn't bad enough that the market crashed, but if you would have bet on a declining stock market, skyrocketing bond yields, and a crash in the dollar, you'd be done by now. And I'm surprised that some of these guys aren't done themselves. You know, either they're saying it on air and not doing that as far as their investment portfolios are concerned so they can generate books, higher speaking fees, and more television appearances, or they don't have a business behind what they're saying. And so I'd be skeptical in that regard, because if anyone had taken their own advice during that period, they should by all measures be done by now. We will have bumps in the road. We'll have a correction in the stock market that's going to scare people probably sometime soon. It's hard to imagine that so far this year, Tuesdays alone, we have had 20 Tuesdays in 2013 that were up consecutively. Never seen that before. Cumulatively, they've added 1,600 points to the Dow Jones Industrial Average this year just on Tuesdays. So far the bet's worked out. I mean, nobody ever thought of that pattern emerging, but just happened this year that has been the case. But the market's held up remarkably well. I mean, the Nikkei in Japan last night was down 5%. It was down 15% in the last week. We didn't even blink. Money just flows to the United States as a safe haven trade every time something happens overseas. So from that perspective, I think that, again, both in relative and absolute terms, we look great, and probably will for quite some time to come. So rather than continue this as a monologue, I'd like to make it more of a Q&A experience and get a little bit more interactive. I will go so far as to answer questions about the 3-year period in which CNBC forced me to wear a hairpiece. That is something I discuss publicly from time to time. It's very good therapy for me, and as I look around the room, some of you may benefit as well. So feel free to fire away if you have any questions, and we can... Yes, ma'am.
First of all, thank you for coming back.
Thank you for asking me.
Thank you for GalaxE.Solutions for bringing me back. And number 3, I got my financial manager loose last year from your talk.
Really?
And I'm doing great.
Oh, I'm glad to hear that. Thank you. Oh, good. Yes.
Is the turn that you talked about because of government programs, I would hate to say, or is it because of a natural cycle, or the nature of our country? I didn't quite understand what's caused all this, and I hope you won't say it's government policies.
Well, it is to an extent. I mean, if there had been no government intervention at the depths of the crisis, we would not be sitting here today. You would not be oversubscribed for this conference. You would not have, you wouldn't have to turn away sponsors, things like that. We would have been in a very, very serious, at least in my opinion, depression where the unemployment rate probably would have gone up as high as it was in the 1930s, 25%, where it is now in Spain, where it is in some countries of peripheral Europe that are suffering through a variety of different problems. Without the backstop that was produced by the Federal Reserve, the proactive actions, I should say, of the Fed to cut rates to zero, there were numerous programs, all of which were just insurance policies when you stop and think about it. TARP was somewhat ill-conceived, but it's been paid back. Even AIG paid back the money, which no one ever thought possible. GM has largely paid back its money. The bankruptcy, I have a great deal of difficulty with in which the way it was handled, but ultimately it probably was, in some sense, the right thing to do. I wouldn't have done it the way the president did it, but it was going to happen one way or another under the economic circumstances in which we found ourselves. Abrogating contract law is not my favorite way to go about this type of thing, and having the president fire the head of GM, that's something that's slightly below his pay grade and he shouldn't have taken credit for. But that aside, intervening and supporting the banks and making sure that they did not become not just technically insolvent, but actually insolvent, and ending up with a bank holiday like we had in the 1930s, and having the stock market go down 90% across the board. That came from the Fed's intervention, the TARP infusion, the various acronym-laden programs that effectively backstopped bank debt, money market mutual funds, and a whole host of other instruments that prevented people from literally pulling money out of the system and putting it into their mattresses the way they did in the 1930s. Without that intervention, we would have had very, very serious problems that I think that we'd still be fighting our way out of today. So, look, I wouldn't call it enlightened policy because the policies that preceded those interventions helped to create the very crisis that they then tried to solve. But then when you look at the dynamism of the U.S. system, corporations got very lean, very mean, very fast. Corporate cash today is $3 trillion, record. Earnings are at a record. The fact that the dollar fell a little bit and allowed us to export more to record levels, that was a function of our ability to compete, restructure, and get back on track, which you don't see in Europe, you don't see in China, and you don't see in Japan. Then you look at the banks, which again were helped by the Fed, but they now have $1.5 trillion in lendable funds on deposit at the Federal Reserve, and they're effectively overcapitalized. And that's a very good thing. And the banks, with a new generation of managers, actually got very responsible, again, very quickly. I think they're being somewhat constrained by too much regulation at the moment, particularly when it comes to lending in the residential real estate market. But aside from that, we have overcapitalized banks, which, again, when you look across the world, that's not the case almost anywhere. And then you just take the innovation processes that are taking place here in the United States. So many things are going on in Silicon Valley, in Silicon Alley, places like Michigan. Even New York now has got for upstate New York, where I hail from, Buffalo's got a similar program to what you guys are doing, talking about, Warren Buffett's out there talking about the new Buffalo. I can safely tell you it's not the new Buffalo. I was just there. It's still pretty much the same as the old Buffalo. And, but they're focused for a change. For the first time since I left in 1974 as a teenager, and I didn't run away. My parents moved to Los Angeles. But they're more focused on bringing jobs upstate and creating manufacturing hubs, or in the case of State University of New York at Buffalo, they have a life sciences division that's now starting to help bring the economy back a little bit. It's the same type of thing you're doing here in Michigan. So the technological innovation that's taking place here is actually happening far more rapidly in the United States than most other places. And what's going to be really significant in that regard is when you look at something like 3D printing, which has an impact on manufacturing, an impact on healthcare. I've been talking to some doctors. They are going to be able to extract, in the not too distant futures, if you have a heart attack, heart cells, reimplant them, and correct for a heart attack and replace the muscles that were damaged during that experience. 3D printing, they're going to be able to print organs. And for an audience like this, it's perfect. It's effectively, you're going to be put up on blocks. The mechanics will come in, they'll replace a part, and then they'll send you back out at a considerably lower cost than today. In fact, one could argue, and some people do, that the healthcare cost curve is bending structurally, which will save the government hundreds of billions of dollars over the course of the baby boom retiring. So a lot of these things, the turnaround from the recession was a government policy-induced turn. What's happening now is private sector activity. The technology that comes with fracking, the ability to engage in horizontal drilling and fracking and take out this much oil from the ground, when 5 years ago we were talking about peak oil theory, all of that's private sector stuff. So it's a combination of kickstarting the economy with an important intervention, but then the private sector economy has done quite well on its own, and hopefully will continue to without any serious interference. Yeah. Yes, ma'am. And I think there's a microphone that if you want to pass it along.
I wondered if you could comment on the potential for a bankruptcy for the city of Detroit and what the long and short-term consequences of that might be.
I'm not certain about the technicalities of this. We've only seen this, on a handful of occasions in the United States, and in fact, Bridgeport, Connecticut, which was the first American city to declare bankruptcy several years ago, that was eventually nullified by the courts. And so we have Jefferson County, Alabama, during the crisis attempt it. We've had a couple cities in California, small cities go. It's difficult in a city, I think, as large as Detroit. It might, however, in a certain sense, be necessary in order to restructure legacy contracts. I mean, the one thing I'll say, and I don't talk about this too often, but we have a relatively unique experience. I think most of us are probably baby boomers, either the tail end or a little farther in. We are a generation that lived in an entirely anomalous period in the history of mankind. Coming out of World War II, where the United States accounted for more than half the world's GDP, after both Europe and Japan were effectively destroyed, and most other countries weren't online as far as global trade and economics were concerned. There really was no China, no India. As far as economics were concerned, no Latin America. It was the US, Europe, and effectively Japan. So what happened was we supplied the world with everything. We rebuilt Japan, we rebuilt Europe, we supplied autos, we supplied food, we supplied all these different goods and services around the world, and again, had a GDP share that was bigger than 50%. So certainly the front end of the baby boom has had the easiest time in human history because effectively they've had 4 bull markets in stocks, 3 in real estate. They've had a chance to get incredibly wealthy. Now they want free health care. That's another story we can save for another day. But there was no period in history where you really had cradle-to-grave guarantees in the United States. It was only that post-World War II experience. And so we built in these legacy systems, whether it was on the pension side, for public employees and private employees, whether it was all manner of social safety nets that got built up. And I'm not against them in a certain sense. I mean, they're very necessary, as we learned from the 1930s. Without them, the Depression would have come again. But we do have to restructure our obligations in such a way that municipalities can get themselves out of situations like this. I mean, Detroit, like Buffalo, deindustrialized effectively starting in the early 1970s, late 1960s, but had all these legacy contracts, and they're still suffering under the weight of them. It's unfortunate, and a lot of it was badly managed along the way. I mean, I could speak for my experiences in Buffalo, my parents' experiences. I mean, probably the worst political environment in the country is in Buffalo, New York. They've never managed to restructure anything in the post-industrial environment, nor did they invite any new industries in to replace those that had left. And so there may not be a way out. I mean, things have gotten pretty bad, and bankruptcy may have to be used. I would hope not. It does cause financial market implications for the city of Detroit, the ability to borrow, the credit ratings, the impact on credit ratings and things like that, and it could make the cost of recovering more onerous. But I imagine there's going to have to be a large-scale restructuring in order to kind of right-size and reshape the city. Now, it's interesting, in a state like California, which up until 6 months ago was in the deficit, now is a $4.5 billion surplus because tax revenues are surging. That could happen in Michigan as well. It's happening in New York. It's happening elsewhere. That maybe some money can be dedicated to restructuring. That would be helpful if that comes about. But bankruptcy for a city is an extreme measure, and it doesn't always help. I mean, if you look back at New York City in the late 1970s, when it was going through its problems, they averted bankruptcy, and they did some intelligent things with restructuring the debt and bringing in smart people to work on the problem, which I think is ultimately the solution. New York had Felix Rohatyn back in those days, who was a very popular and smart investment banker. I think Detroit, and I don't know your interim emergency manager that well, but I think the state and the country actually need to bring some very smart people to work this through, but there has to be cooperation on all sides. So one thing, when you see situations like this, everybody's a stakeholder, everybody has to give a little bit, and we certainly don't see it in Washington. Hopefully we could see it here without having to go through a Chapter 7. That would be, a Chapter 9, pardon me, that would be disruptive. Yeah. Yes, sir.
I'm curious, your thoughts on where interest rates are headed over the next year or 2 or 3. Is there a bubble in the bond market?
Well, I hate the word bubble for the bond market only because typically bubbles are much more reflective of greed than they are of fear. So if there is a bubble in the bond market, it's a fear bubble as opposed to a greed bubble. People have put their money in fixed income instruments because they're too afraid to put it anywhere else. And because the Fed's repressing rates both at the short and long end of the curve, they haven't lost money doing that. If we were to see a spike upward in interest rates, particularly for people who own bond mutual funds, which have no maturity date, if rates were to say go to 3% on the 10-year Treasury note, they're going to lose a significant piece of their capital. Now, if you're holding just the bond, you can hold it to maturity, and what you lose is the opportunity cost of investing that money elsewhere. But for people who are heavily involved in fixed income bond funds, if rates were to spike higher, they will suffer rather greatly. Now, that's not my base case. I still think that while I'm bullish about the economy, the Fed is so focused on underemployment, and not just the unemployment rate that we typically look at. Number comes out next Friday, which is 7.5%, 7.4%. They're also looking at the underemployment rate, which is still well above 14%, the so-called U6 rate, which includes people who are working part-time for economic reasons, discouraged workers, people who have left the labor force. That's a much bigger, much higher rate. And Janet Yellen, who's the vice chair of the Federal Reserve, has actually referred to that rate much more often than she has referred to the typical unemployment rate that we talk about, and getting that down substantially. Ben Bernanke himself says that we want to see a regular unemployment rate at 6.5% or below before the Fed even starts talking about changing policy. Now, we've had rates pop up in the last few days because we've gotten some stronger than expected economic data, and people have been moving now rather belatedly their money out of bonds and into stocks, and so that rotation has begun, and that's put upward pressure on rates. I'm not in the camp that believes the Fed's going to start tapering its purchases this year. Bernanke gave a two-handed assessment of that last week and kind of confused the marketplace. You have way too many Fed officials giving their opinions right now so that you can't really discern what the central thesis is at the Fed. My bet is still that they don't do anything until 2014, that if rates were to get out of control on the upside in the 10-year note, for instance, they would increase their purchases and drive yields back down under 2%, because mortgage rates under 4% are going to stimulate a lot more activity. They're not comfortable that housing is self-sustaining. They're not comfortable with the unemployment situation. So I think that they will not make the mistake, and Ben Bernanke studied this quite closely, that was made in 1937 here when we raised taxes and rates simultaneously. We went into a second discrete depression. The mistakes that were made in Japan, very similar. They're still, 23 years later, struggling to get out of the bursting of their twin bubbles that started in 1990, because they made the mistake of raising rates in 91 and doing all. They put a sales tax in 1995. They crushed their economy. They're still deflating, and they still have a variety of problems in their economy 23 years after their market peaked. So I would say that the Fed is still going to err on the side of lower rather than higher rates. They may have to do battle with the market at some juncture. The one piece of good news that I would say with respect to that question is if rates do go up and the Fed allows rates to go up, it means they believe that the economy's on a self-sustaining path that doesn't require much more intervention. That would be very good news. The stock market will correct in the interim because it will have to readjust to higher rates. We've based everything now on a zero rate environment or a less than 2% rate environment when it comes to investing in equities. So we'll have a 10 or 15% correction. From my perspective, if they're letting rates go up because the economy is getting better, that's a buying opportunity in stocks once we have that experience. By and large, though, I think they will not, and I think this is a guarantee, they will not raise the Fed funds rate, short-term overnight lending rate, till 2016 or 2017. There are so many things they have to do between now and then to be able to raise that rate that it's going to take a long time. You can't just go, as Dick Fisher of the Dallas Fed said, you can't go from wild turkey to cold turkey, right? Which is effectively what they do if they tried to raise rates now. They would theoretically have to shrink the size of their balance sheet. They do some other things in the interim, paid banks more on their deposit rates at the Fed before they start raising official interest rates. So it's going to be a while before they do that. Whether they taper their bond purchases by the end of the year, maybe even earlier, the Fed's still going to be wildly accommodative for a couple more years. And certainly it'll be several more years before they officially raise rates. Yes?
Oh, you can let go of that.
You're fighting over the
like
microphone.
my mom here. So there's been a lot of talk about conventional energy at the conference and in the news, and I think you call it, it's going to be a game changer. So what does that mean for the clean tech, green tech? Where does investment go for the wind power and solar? Where do you see that headed?
Well, it's still good. To borrow an expression from the president, and from what I gather from at least one of the questions, it's not a popular person to quote. But when the president said an all of the above strategy, I think we will still have that with respect to wind, solar, and there are actually some areas of the country that are focusing almost exclusively on solar. Wind is a little bit different. For wind to be profitable for people investing in these huge corridors that stretch from North Dakota to the Canadian border to Texas, natural gas prices have to be up around $9 per 1,000 cubic feet, and we're at $4.20 now. So in some instances, some of these, that was a Flintstones noise on somebody's phone. That was cool. You need conventional energy to get more expensive to make green tech and clean tech more desirable. And quite frankly, the opposite is happening right now. I mean, if I were to have to bet 10 years from now whether U.S. oil is going to be $50 or $150 a barrel, I'd bet on $50, which means that there would be very little incentive to go crazy doing these other things. And I don't mean that in a pejorative sense. I mean the scramble to find other sources of energy would be considerably slower than it was 2 years ago. Remember, we were just discussing peak oil theory 5 years ago, how the world was literally running out of oil. The United States is not the only place where fracking can happen. We happen to have a 5 to 10 year lead technologically on other parts of the world, but you can frack in China, you can frack in Russia, we can pretty much frack wherever we want. And the problem is the technology is not necessarily available in other parts of the world. So the pressure to find clean and green tech solutions may not be that high. It's interesting to note that carbon dioxide emissions in the United States have fallen rather dramatically in recent years. Methane is going up because fracking actually releases more methane than CO2. So we still have some environmental issues to remediate when it comes to that. But I would argue also that a lot of the environmental problems exist overseas, and without having China or India or other countries join in the effort. I mean, for those of you who've seen pictures of Beijing, Mexico City used to be the most polluted city in the world, and Beijing makes that look clean by comparison. You have to wear masks in China just to walk around because you can't breathe the air. When I was in Los Angeles as a teenager, it was the equivalent of smoking 2 packs of cigarettes a day to live in the San Fernando Valley. And Beijing is some multiple of the level of pollution that we had there. LA is considerably cleaner today. So we're going to see all kinds of innovations in technology when it comes to energy. Again, whether it's a shift towards more hybrid cars, more conservation, more electric cars, whatever, whether it's using solar and wind to the extent possible, the cheaper conventional energy gets, the less we're going to chase unconventional energy. And I think that's just an economic reality. It will also do wonders for our economy in the sense that as we become an exporter of those products, it's a physical commodity we can export, it also changes the balance of trade rather dramatically. And so we'll have to see. China's trying to go solar as hard as they can, but again, they're making lower quality goods. Their panels are cheap, but they're not as high quality as what's being made here. We still have an edge in some of these areas, I think, technologically. Where we might find some interesting developments, Lockheed Martin has developed a product called graphene for desalination. And water is going to be a very big issue globally, as you might imagine, as the population continues to grow. And they've got this extremely fine filter that's almost kind of a molecular level type of filter for taking salt out of seawater. That's something that's going to be a big deal. So we're on the cutting edge in a lot of different places environmentally when it comes to like desalinization. Again, though, if oil were to drop to 50 or 60 bucks, we'll get some portion from wind and solar. I mean, nuclear is kind of out now, given what happened in Japan. And it's out in Japan, which is why they're going to be importing liquefied natural gas from us over the next many years. So again, the pressure to find those unconventional means, I think, will be less than it's been in the last several years. We have time for one more question. Yes, sir.
You talked at the beginning about some countries that economic policies are not positive. Tell me about 3 countries outside of the U.S. that you are intrigued by in terms of their positive momentum.
3 countries that I am intrigued by outside the U.S. with positive economic policies. I would say Japan right now is interesting. Now, I started talking about this at the end of last year, beginning of this year, because it looked like, again, another easy trade. The Bank of Japan decided that it was going to engage in the types of policies that the Federal Reserve has been engaging in a massive way. And so the Nikkei went up from November of last year through last week 80%, and we've since had a 15% correction. If they engage the bond vigilantes in Japan now who are driving interest rates up, if they engage them and overwhelm them, I think the Nikkei will be a very interesting investment. The Nikkei peaked on December 31st, 1989, just, I think it was 9 points below 40,000. Went down to 7,000, came up to 15,000, and it's been a jagged ride for the last 23 years. You could go all the way back to 40,000 and not be out of a bear market in Japan, right? I mean, if you just touched the old all-time high, that you could still be within the bounds of a bear market, but you would have made money from 7,000 up to 40,000. So I think it's probably going, assuming they fix some of the problems they're having at this moment with policy, that the Nikkei is likely to go to at least 20,000. It's at 14,000 and change. That's one country that I think is intriguing from just buying the Japanese ETF, a currency hedged ETF. Now, I typically don't promote products. My colleague Maria Bartiromo's husband runs Wisdom Tree, but they do have a very interesting product, which is a currency hedged Japanese stock market ETF. So you could buy Japanese stocks and take the currency risk out of the trade and get the full benefit of market appreciation. That's one country that I think is very interesting. It gets harder after that. I mean, Germany is quite interesting. German stock market hit a new all-time high successively along with the Dow over the last several weeks. It's pulled back a little bit. Of the countries in Europe, they're actually quite interesting. Italy would be the other one in Europe that I'm kind of intrigued by, even though they have the biggest debt to GDP ratio besides Japan in the world. Their stock market's done quite well. Their borrowing costs have come down rather considerably. It's the craziest country. I mean, they're my people, and so I can say this. It is the craziest country on the planet. They've had roughly 45 or 48 governments in the last 50 years, with the exception of Berlusconi being probably one of the longest sitting prime ministers despite all his problems. But somehow, Italy makes products that are sold overseas. Very active, obviously, tourist destination. And despite all the problems they have, their market, I think, is intriguing to me in the sense that they do manufacture and export a variety of high-quality products. And it's very difficult to say that about other countries in peripheral Europe. France, I think, is a disaster waiting to happen. They're talking about tax rates of 75%. You have to leave. You can't stay. You can't innovate. You can't do anything under a situation like, Gerard Depardieu moves to Russia. It's so bad that Gerard Depardieu moved to Russia. That's how bad it is, okay? So if that's the trade, that's the country to stay away from. But you don't see a lot of Italians splitting, I would never touch Russia. I don't care how much their market goes up. When it goes down, you can't get out. There's no rule of law. China could be interesting for a trade, but China, to me, is just a trade. I don't believe the secular story about their long-term growth prospects. The stock market from peak to trough, since we started recovering, the Shanghai Composite's come down 50% while we've gone up 145. So for everybody who is saying China, China, China over the last 5 years, you just had a 200 percentage point swing in performance between the U.S. and China in the U.S.'s favor on a relative trade basis. So Japan, Germany, Italy, I think are very interesting. Smaller places like Vietnam, can be interesting. But again, that stuff, when you start doing frontier markets, you have to be very careful, and you only dedicate a very small portion. You know, I mean, if you can get them, Puerto Rican municipal bonds are quite interesting because they yield 5-ish%, but they're scarce at the moment. And so those are some of the things that, you know, I think are intriguing to me. I really still think the U.S. stock market, by and large, is probably the best place to be for the longer term. So I thank you very much. It was great being back. Appreciate your attention. Tim, thank you.
Thank you.
Appreciate it.